This is Trader's Workshop with Adam H. Grimes. Hello, good morning, good afternoon, good evening, wherever you are in the world, wherever you're listening to this. Welcome to episode 23 of Trader's Workshop, Questions and Answers. I'm your host, Adam Grimes. You can find more of my work at adamhgrimes.com, and you should just go follow me on Twitter at adamhgrimes. So I want to begin today with a few kind of random thoughts, but they're things that I've been spending a lot of time thinking about, and some of these Tom and I have been spending time talking about and thinking about. So there's some kind of exciting things happening. And then I have a number of your questions that I hope to provide answers to. I don't know how good the answers will be, but I will get you answers. I also want to say, generally I make a point of recording these podcasts with no cuts and no edits. I'm trying something a little different here. I'm recording in the middle of what could end up being an active trading day. So this may be a little bit more chopped up, and if you hear alerts and then an awkward edit, you know what happened, okay? So I guess to begin, we're coming into the end of the year here, and into actually the shortest day of the year is tomorrow. This is being recorded December 20th, 2018, and I tend to think that these seasonal rhythms of the holidays and of the year and of the solar calendar even and of our lives, I think these things are very important, and it's easy to get detached from that rhythm because we do the same thing every day, right? We all fall into some routine, and even if there's the idea that if you trade markets, you're liberated from routine. In some ways, yes, but in some ways, gosh, I can tell you, there are certainly a few points every 24 hours where I'm really paying attention, and sometimes I'm locked in for hours. So we do fall into some regularity, and I think this is a time where it makes sense to kind of reflect on where we've been and where we're going. And I do want to take a few minutes here to each of you, whether we've interacted or you've read my blog, listened to my podcast, or become a client of some of my services. I just want to say thank you. And that's not a casual thank you. A lot of times we just throw a thank you out there because it's filler, it's the thing to say. But for me, everything that we are doing here only makes sense if you are part of it. And this was something when I was a more active musician and composing, I was really aware of that it's kind of the question, the tree falls in the forest, no one hears it, does it make sound? If anyone writes music that nobody listens to, does it really matter? And I felt very strongly it does not matter without the listener, because it's a circle of communication, and everything that I do is for you. And I hope that doesn't sound too cheesy or whatever, but the motivation that I get from knowing that I've made a difference in some of your trading is just, honestly, words fail me. So I certainly appreciate your support and your time, and those of you who have shared your thoughts, whether to support or challenge me at different points. Thank you very much for that. I also want to say, and these podcasts obviously support everything else that I am doing and we are doing. And we've had a really fantastic year with my new company, Talent Advisors, and with MarketLifeTrading.com. I'm sitting here drinking a very nice Assam tea as I do this podcast, so apologize for the unprofessional aspect of that. But I do want to encourage you to take a look at those services. We offer free trials. And for Market Life, a more than 100% money back guarantee. And I think that's a little bit unique in the industry. You hear horror stories about people accidentally signing up and not being able to get a refund. And we don't want any of that. It's always a risk for you to take a look at my work is a risk for you, right? You're risking money. Maybe my stuff sucks. It doesn't, but maybe it does. You don't know that until you actually see it. Maybe for whatever reason, it's not right for you. And so you certainly risk your money and you risk your time. And there's not much that I can do about your time, but I wanted to I'm confident enough in the value of what we do that I want to take the financial risk. So if you happen to try Market Life and you end up hating it, we give you more than 100% of your money back. So, we pay you to look at our stuff. So go to marketlifetrading.com or Talon Advisors, that's advisors with an O.com. And just really quickly, how are the two different? If you are learning to trade and if you're focusing on stocks or currencies, Market Life is probably for you. You get daily video analysis. You get a ton of screening tools. Basically, it's like sitting down with me every day and talking about the market. And the feedback we've gotten on this format, it's no hype, no promise that you're going to do trades and get rich or make a $3,000 account, a $500,000 account. Anybody who tells you that is lying to you. And we're going to take that on a little bit more aggressively in the new year and talk about how and why those people are lying to you in so many ways. And we don't do any of that. So the only promise that I can make you is that we do give you solid fundamentals. And fundamentals, I mean basics, the elements of building a trading system. And you get to see right or wrong. You get to see my thoughts and analysis every day and see how the market unfolds as we try to take it apart. And to be honest yet humble, I think we've done a fantastic job of being on the right side of the market this year. I'm not the kind of person to tell you how great we are with that, but we've had a good year. Let's just say that. And so that's Market Life. Talon Advisors is the outgrowth of my institutional research that I have written for almost 10 years. And that's for institutional professional traders, also for developing traders on longer time frames. And we do a lot of work with incorporating fundamentals into technicals. You don't see a lot of that work because it happens behind the scenes, and the technicals actually lead, so we correctly focus there. But there's a little bit different flavor to the two services. I would suggest take a trial of both and see which works for you. Cancel the one that doesn't. But that's marketlifetrading.com, talonadvisors.com. I don't do many ads in these podcasts, and we decided that we're not going to get sponsors. We're not going to advertise other people's services. So I'm sponsoring these podcasts, and there's a statement from our sponsor. Also, personally, we have some really exciting projects online for next year, dealing with maybe, and some of these are question marks, some of these are experiments. I'm wondering if I can find better, more efficient ways to treat price action. I feel very strongly that I've seen all the work, all of the books and all of the blogs and courses that really focus on bar by bar trading. And I've had many people suggest, hey, you should write a book like that. And I said, well, the only problem with that's okay. Those books are very well received. The only problem with that is I don't think there's any validity to that analysis, because and we've talked about this many times, but every tick of every bar is certainly not important because the market has a very high degree of randomness. So if you are focusing on every nuance, every detail of every price bar, I think you risk being misled. So I've really fought that, but I think there is a way to do this within looking at details within context also, and it goes back to my first book, right? Market Structure and Price Action. And so that's something that we're playing with to see if I can find more efficient, better ways to teach. It's always a quest, right? And we do have, I will tell you that with these companies we're running, we have it's many years off. It's probably 5 years off, but we do have a pretty exciting end game that is really focused on trying to create a lot of consistently profitable traders. That's our objective and our entire reason for being. And well, we'll tell you a little bit more about that as things develop. Also, on a personal note, one of the things I think you'll be seeing from me next year is probably some more music, which I'll put out on my YouTube channel. But actually, if I ever disappear, what I've done is gone up on a mountain with my Bach partitas and trading currencies, and that's. But I'm actually finding some ways to and looking for overlaps and connections here, because I just did a podcast on the connections between music and trading and markets, and my conclusion from that podcast was that there really are not many of the connections that people think, but the connections that do exist are the connections that relate to learning, pursuing mastery, pursuing excellence, pursuing as close to human perfection as possible. And those concepts, since I did that podcast, as I've focused over the past couple of years more and more on my music again, I've also started, and especially the last few weeks after that podcast, I've really thought about how to take those ideas and incorporate them into my writing and work and my teaching of trading. And I had one of the traders I work with said something that I really brought a smile to my face. He said, just to paraphrase, that he was kind of becoming obsessed with this idea of pursuing perfection in every aspect of his life, and that it was something that he found a little bit difficult to discuss with people. But, he said basically, there's like nobody else who can understand this, who I can talk to about this, but it's becoming such an important part of my life and thinking. And I think that is I certainly see that in myself. Relating, those of you who've seen my Instagram, my obsession with cooking and my obsession with writing, with I haven't done it, but with critiquing good fiction writing, thinking about how I might write fiction someday, but with my technical writing, with my nonfiction writing, I strive for a certain poetry within limits of what you can do with technical writing, which is actually quite a bit in terms of pacing and sentence structure. And so this idea of everything we do pursuing as close to perfection as we can. Well, maybe not everything, but picking a few areas. I think if you can get stuck if you try to do everything, but really, it takes over your life in a very constructive way and a very transformative way. So those are some of the ideas that are kind of swirling around. We're going to be thinking about more in the future. Now, maybe this podcast should actually be titled "Adam Rambles a Lot." Would not be a terribly informative title, because Adam rambles a lot in every podcast, but more than usual here. So after that ramble, let's get to these questions, because I've got a few pretty good ones here. So here's one. In a recent blog post, or maybe it was a note to clients, you said you do not see much value in trade reviews. I guess that partly relates to the idea of the market being random for most of the time. However, many other trading coaches, mentors, educators recommend every trader diligently review past trades with marked up charts, statistics, etc. For example, a book of charts or playbook. I'd be happy for you to share your thoughts and opinion on that. Okay, so it's a good question. The question is, how do we do trade review? And the answer, I think, comes from, what do we expect out of trade review? Well, why are we reviewing our trades? To become better traders, obviously. We want to eliminate mistakes. We want to make more good trades, and we want to make fewer bad trades. So that's the objective of trade review. Now, how do we get there is the big question, and the traditional way this is taught, and the way that, by the way, I advocated for years, and I did myself, was you sit down and you look at your trades, and maybe you even follow a procedure like you find your biggest trades, your biggest winners, and you look at what they had in common, and you try to do more trades like that. You look at your losers, and you try to eliminate losers. The problem with this is, of course, as the reader has correctly identified, the problem is that the market is extremely random. And the market is an extremely cruel teacher. You know, in my first book, I think it was, I gave the example of, imagine a child in a classroom, eager to learn, trying to soak up the knowledge, and the teacher reinforces randomly. But when we say random reinforcement, what that usually means is when you do something right, sometimes you get a reward, sometimes you don't. However, this teacher is completely random. Sometimes the student gives the right answer and the teacher absolutely screams at the student and tells the student how wrong and how stupid the student was, and the student was correct. And sometimes the student can be very lazy, can be blazingly wrong, and the teacher looks at the student and says, wow, good job. This is what the market does to us. And if you can imagine a child trying to learn in that pathological learning environment, it would be almost impossible. Well, this is why many people feel that learning to trade is almost impossible. This is why many people who have tried to trade have come away. It's one of the big reasons why people come away with the idea that this is impossible. You can't do this. The random reinforcement. And the fact is, as a trader, you can have a perfect setup, you can do exactly the right thing, and you can lose money. Or you can be a complete idiot. You can, for instance, you can write options very close to the money in very volatile markets. And you could potentially do that for months or even years and get away with it. And not only would you look smart and feel smart, you would have evidence, would you not? You could even have hundreds of trade examples of trades that have worked. So the problem is there's a risk lurking here that is not apparent in your trade results. And with the option writer, the risk is eventually the market's going to move in a way to completely blow that option writer up and take the account negative. And that does happen unless you have proper risk control. So that once I began to fully embrace and accept the idea that the market is very random, I realized that trade review is a problematic concept because in particular, you know, I would see traders, and I've worked with some people who would take traders who've done less than 100 trades and then have the traders pull out their winners. Well, first of all, the trader, and this is you when you're starting, you're very emotional, and pardon my rudeness here, but you're a complete idiot. We all are. You know, I certainly was when I started trading. You will do the wrong thing with shocking regularity. If you ever make money, it's just because you got lucky and dumb lucked into it. And your rational decisions are overwhelmed by emotions. If you're in that state, does it really do you a lot of good to look at charts? At this point, what we need to understand are, I think there are really two critical things. The first is, does your trading plan have an edge? And the answer to that in the vast majority of cases is no, it does not. And I think that this is why I have emphasized over and over for developing trader, this is where you start. Does your trading system have an edge? When I say system, I mean broad system, methodology, approach, trading plan. These are all words you could plug in there. And I'll use them interchangeably just to make this more confusing. But if your trading plan does not have an edge, then none of this other stuff matters. Then what you're doing is you're going to Vegas and you're playing a game that is reliably slanted against you. And the best you can hope for if your trading plan does not have an edge is that you will be disciplined enough, you will manage your money well enough that you will lose money and bleed to death slowly. If that's a desirable outcome, then that's what you accomplish by being a disciplined trader with good money management with no actual edge. And of course, that's not what you want. Nobody wants to lie on the side of a mountain freezing to death and bleeding to death slowly over the course of days or weeks, right? That's not what you want, but that's what you will do as a trader. And so what is of absolutely paramount importance is to make sure that the trading system has an edge. Now, when these mentors and coaches tell you to review your trades, that's what they're driving for. That's what nobody wants you to waste your time with trade review. What they're trying to do is get you to the point where you can see where your edge is and understand your edge. What I'm suggesting is that you approach it from a different direction. You approach it from the standpoint of, first of all, does my plan have an edge? And my trading course, which is completely free and you should go check it out. It also is at marketlifetrading.com. Does not cost you a penny. It will lead you through the process of developing a trading plan and verifying whether that plan has an edge, so you know whether to waste your time with it, time and money with it, or not. And if you don't have an edge, there's no point wasting your time and money actually executing. So if you have an edge, that's number one. Then number two is, are you following the plan? This is where psychology becomes important. This is where behavioral aspects, this is where discipline becomes important. You can't have discipline if you don't have a plan. Think about that. What if I took a new trader and I said, okay, here's a trading account. Go be a trader and be a disciplined trader. Now, this trader doesn't have a plan. So how's this trader going to be disciplined? What does that even mean, be disciplined? Don't lose all your money on one trade? Well, I guess that means actually that mathematically that trader should bet the entire account on one trade. That's where their best edge is going to be if they have no edge. But you see what I mean? That if you don't have if you don't have the edge, if you don't have an edge, then you're looking for basically as few times at bat as possible. However, if you don't have a plan, you can't have discipline at all. There's nothing to be disciplined to. Discipline is just the measure of how well you follow that plan. And if you're following a plan that doesn't have an edge, you're going to bleed to death slowly. So you got to have an edge, and then you have to follow it. Now, what I would think is more important to review is, first, we need to verify the plan, the edge behind the plan, and then we need to monitor behavior. So this is why each trade really should be evaluated on the basis of, did you follow the plan? How well did you follow the plan? That's what really matters. And this is similar to, we're kind of stealing something here from quantitative trading. No quantitative trader looks at a bunch of charts and says, I want to do more of my big winners. Because we realize that win or lose, you have no control over that. In fact, in my trading plan, I have a list of things that I am not responsible for. And what I am not responsible for is the outcome of any one trade. Think about that. And most of you know this, right? This is clear from Mark Douglas, I think, is where this idea really, in a very constructive way, found its way into the common trading thought. Any trading system and there, I'm mixing my words again. Any trading methodology, it's all the same thing, has a random distribution of wins and losses. You're drawing from a probability distribution. There are big wins, there are big losers, there are a lot of small wins, small losers, there's probably some break evens, and the shape of that distribution is it's basically the bottom line for your trading system. That's the expected value of your trading system. And hopefully that average is a little bit positive. If it's not, then you don't have an edge. But you're drawing from you're taking a random draw from a probability distribution. This means that any one trade might be a big winner, might be a big loser. And this goes back to the pathological teacher that I described. I could do exactly the right thing and just randomly draw a huge loser. Heck, I could do the right thing and I could take a 4R loss, right? I could do the right thing and the market could gap beyond my stop tomorrow and I take a gigantic loss. Now it does, when that happens, I'm human, so I'm not going to feel very good about it. I'm probably going to be upset. I'm probably going to feel angry. I'm probably going to have at least some passing feelings of self-doubt. And, this is normal. You're human. But it's quickly counteracted with the medicine for that is your rational mind saying, wait a minute, this was just a random outcome. Did you make a mistake? Did you follow the trading plan? And if the answer is yes, I absolutely followed the trading plan. No, I did not make a mistake. Then that was a good trade. I don't care you lost 4 hours. That was a good trade. Similarly, imagine, not that any of you would ever do this, okay? But let's say you get into a trade and it goes against you and it's almost to your stop. And this is not part of your trading plan to do this, but you cancel the stop. Now the market goes under your stop and you have a bigger loss than you expected. And now you're frustrated. You buy more. Now it's past your stop and you're double size. And then the market takes a gigantic move in your favor. And you make 6 times your initial risk on that trade. It's your biggest winning trade for the year. How do you feel about that? In fact, I know somebody who basically did that and made the equivalent of almost 3 months of his profit for the year on that one trade. That person is no longer a trader. Because it's such a powerful learning experience, you made a lot of money. Obviously, it was the right thing to do. Well, you did exactly the wrong thing and you got very lucky. Here, the random teacher told you when you learned your multiplication table and you said 3 times 3 is 8, and the teacher said, oh, you're so smart. Why don't you go take an extra vacation? Here's some candy. Go play outside. Do more of that. That's what happened to you. And so if you're evaluating that based on looking at the chart, what you will see is, oh, there was some technical structure, wave pattern, Gann, Elliott, Fibonacci, whatever crap you want to come up with. I saw my reversal. I was playing against support. I gutted it out, and you got to be in it to win it. You have to say some stupid Wall Street sayings, right? You got to be in it to win it, and when the going gets tough, whatever. Where if you're evaluating it from my perspective, you see very clearly that was a horrific trade. You made a mistake. So what's much more important than looking at a chart is monitoring your behavior. That's why, yes, there's certainly a place for trade review. I learned a lot from trade review, but it also was from looking at a gigantic sample of my trades, hundreds of trades, in some cases more than 1,000. That was where I came to the conclusion that divergence really does not provide me with an edge, because I was able to go back through actually executed trades and look at the information I was getting from divergence before the trade to know whether that was constructive addition or not. So there are things you can do with trade review, but I think it needs to be done over a very large sample size. Again, we're borrowing a little bit from the quant playbook here, but the idea of looking at your charts for your biggest winners over any particular, and gosh, let's really make it dangerous and limit it for a specific time. Let's day trade for a week and then go look at your biggest winners for that week and try to do more of those. Or, even for a month, or swing trade for a month. That is so dangerous. That I would say somebody really internalizing that. People are successful doing things that aren't necessarily constructive. So somebody somewhere has probably been successful with that, but you're certainly tilting the odds against you. So there are my thoughts on that. I do have opinions, right? Somebody asked, what are my best intraday setups for S&P, NASDAQ, or crude oil futures trading? I traded S&P intraday for years, NASDAQ a little bit. Basically, or in Russell for a little bit. I don't think there's diamonds too, I guess. Okay, so anyway, my point is there's really no point, I think, if you're looking at different setups for, say, the S&P and NASDAQ, you're just trading stock indexes. So there's no point in dicing it that finely. Now, maybe you'll find some different setups for crude oil or bonds or currencies, ways you would think about it differently. But the best setups that I have found intraday generally relate to 2 things. One is the idea of pullbacks and trends. It's no coincidence that when I write about patterns, I'm usually writing about pullbacks. This has been effective for me as a swing trader, as a day trader. Of course, the problem with day trading is the trends are shorter, they end rather suddenly, and a lot of markets don't trend all that well, but they do. They still trend, and there's opportunity there. And so pullbacks and flags, that's why we focus on those patterns. And then the other thing that's a little bit different intraday, I'm a little suspicious of the concepts of support and resistance in many ways, because I think people who focus on that may not always fully appreciate the power of cognitive bias to create these support and resistance levels where they don't actually exist in the market. But what are real levels? Well, the high and the low of the day. I'm sitting here before noon on December 20th, 2018, and I've just watched the S&P slide through the low of the day after testing the high of the day an hour or so ago. So action around these highs and lows, it's very, very important. And knowing what is happening at the highs and lows, and there certainly are trades you can set up there. And you can play games with Globex session, with overnight session, or if you trade currencies, you can look at different sessions. But I think really all you need as an intraday trader is really one setup. It needs to be a setup where you'll get enough trades. Like, if you have the best setup, but you have to watch 5-minute charts all month and you're going to get 2 trades a month, that's probably not really enough to base a career on. But if you have a pattern that sets up reasonably often, then you only need one, maybe 1, 2, or 3 would be kind of extreme patterns. So I would start and focus on pullbacks, and that's why I do focus on that in my work. Most quantified systems for intraday trading are based on mean reversion. And you will find, if you start to do quant research, that generally speaking, mean reversion is a little bit easier to quantify. Okay, a couple more here. So my opinion on this is good actually, because it dovetails into that. My opinion on focusing on and only trading a few markets, but knowing them inside out, versus missing opportunities / volatility in other markets due to a relatively narrow focus. So in other words, is it better to focus on only a few markets, or is it better to kind of try to trade everything? Well, I think if you stay in the game long enough, you're probably going to trade a lot of different markets. But I don't think there's any one answer to that, because you certainly will see traders who focus on only one market. In fact, you'll see traders who only trade one stock, and they feel that they have some specialized knowledge. I knew somebody who only traded Valero for years, and she felt that she really understood the market dynamics. And my argument was always, I think you could probably take that knowledge to another stock, but it was enough. She had fine. And then you'll have nutcases like me that trade everything. And is one, a part of it might be my short attention span. Part of it's been my quest, honestly, to learn about all markets and different kinds of trading. But and we're getting a little bit more action here in the market, not to commentate, which is not actually a word, I think, but too actively on what's happening in the market, but relating to that slip through the low of the day and then momentum. See, that's an example of something that I would not try to set up a trade based on that, just on an anecdotal observation. But if I was working on creating an intraday trading plan, it's probably something I would be aware of. And you want to know, how often does that happen? So I don't think I think for a beginner, here's where it might be most clear. For a beginner, I think you probably do want to focus on a relatively narrow set of markets. The more you can narrow your focus, the quicker you're going to learn. I will also say that even though I know this is not true, but I feel that I do relatively the same thing in every market that I trade. Why do I think that's not true? Because when I switched to a new market, I struggled. And I suspect that this was because there's some implicit learning that's gone on behind the scenes that I'm not quite aware of, that tells me how I need to trade currencies and stocks, for instance, a little bit differently. And so I think if you're trying to learn the same patterns and then trade a bunch of different markets at the same time, it's probably a very difficult way to learn. So I would say focus as a learner. One of the other things that I would suggest is that I'm not sure you've lumped volatility together as an opportunity. And I'm not sure that's always true. I think a lot of day traders talk about that, but if you're kind of crazily chasing the volatility from one market to another, that works against consistency. So it's something you certainly do want to be aware of. And then one more question here. I never saw you talking about trading goals, things like close the month or the week or the day after so many losses or so many take profits. Do I think it's not necessary? Well, okay, so when I was day trading very actively, this was something I kind of went back and forth on. And the question is there some point where you should pull the plug on the day? In other words, should you have a profit target like, I'm going to make $3,000 today and then I'm going to quit trading? Well, or conversely, I'm going to lose so many dollars and I'm going to quit trading. What I found was, and this came back to the idea of understanding market cycles, that some days are better trading days than others. Some days, depending on your style of trading, this idea that somebody will go into the market and it's an ATM machine and gives them money every single day, I think that's true of high frequency trading. I think that's true of, it's certainly true of some institutions that basically have knowledge of customer order flow. You know, when you hear about big banks that basically go a whole year without a losing day, well, that's much of what's going on there. It's not that somebody's figuring out a great trading system in Python. They have information that you don't have. What I found was that some days it's like you're a farmer, and some years the weather is better than others, right? Some years you might put a crop in the ground and it doesn't rain and you barely scrape anything out. Other years are abundant. And it's the same with trading. And I found that if I had terminated my trading at a predetermined profit goal, that I was really cutting myself off from the big days. When you're in phase, when the market is favoring your play, it makes sense to press. And by press, I mean just sit there and follow your trading plan. Don't do anything crazy. Don't trade bigger. Don't get more aggressive. Don't take more trades. Just do the right thing, okay? But don't stop because it's a day that favors your play. And however, the other side of it was that there are some days that are very adverse. And there are some days, because if you're a discretionary trader, you are part of the trading system. You can be as analytical as you want, but there are some days that you're going to be a better trader than others. And so I had a rule that when I had 3 losses in a row, that should not have happened based on the way I mean, you know, it'll happen randomly sometimes. So, okay, some days you get a random day off, but more often than not, what it meant was I was not trading well. I was not seeing the market well. I was not in the right place mentally. And that was my clue to stop trading for the day. So that's, and you know, certainly the idea of having some predetermined loss for the week or the month, where if you lose X percent of your account, you're going to cut off trading. That's a very useful firewall. And that can, what that certainly can do is prevent you from blowing up, because it's very easy to take a 10% down month and turn it into a 50% down month. And you do something like that, you find yourself in a very, very, very bad situation. So having those stop points, if you're not trading well, I think are very important. But you know who I hear talking about the profit targets? It's a lot of the scammers. A lot of the people who give you this idea that you're going to go to the market every day and you're just going to make $100 a day. You're going to make $500 a day, but you're going to do that every day. And of course, that does not pan out. That doesn't develop like that. Now, there are probably legitimate traders who do that, but I think in general, and there's also, you know, there's always this tendency when you get up a lot, whether it's on the day or on the month or even on the year, I just want to lock this in. I don't want to do anything to mess it up. It's normal. And I think if you trade for 100 years, you're still going to feel that. I'm just going to lock this in. Well, I hear myself say that to myself. And then I think, what are you thinking, dummy? the reason you're up a lot is because A, you're a good trader, and B, you're in phase with the market. So keep doing what you're doing. And there have been times that I've locked it in, and there have been plenty of times I've locked it in, and it's probably a mistake. So that's me. That's a personal answer. You ask my opinion. That's my opinion. But those are the things that I would think about. And I do think it's probably important to have some point where you cut yourself off as it's kind of like a stop loss on you. You get into a trade and you put a stop on the trade, but you also need a stop on the trader. So when things aren't good and when you're not good, then just wait. Step away. Wait. Okay, well, I think that's a pretty good point to wrap up. We may get another podcast out here before the end of the year. No promises, but if not, I hope you have had, are having, or will have a fantastic holiday and a happy new year to everybody. And once again, heartfelt thanks to each of you for listening, caring, and supporting my work. And I look forward to a fantastic 2019. Thank you very much.